The greatest stock picker of all time, Warren Buffett, is stepping down from Berkshire Hathaway at the end of the year. The company is sitting on over $300 billion of cash waiting for an opportunity to invest in. So is now the time to buy Berkshire Hathaway stock? Hi, I'm John from ValueGlance.com. I have a PhD in theoretical physics, and I've worked as a research analyst on an 11-figure fund at a $1 trillion asset management company. I'm also the author of the book Stop Checking the Price, which describes a simple strategy to find high-quality stocks for the long run. So today we're going to talk about Berkshire Hathaway, ticker BRK-A or BRK-B, depending on Class A or B shares. They trade the same. The company is a conglomerate. It owns businesses, public and private, across a range of industries: insurance, retail services, manufacturing, energy, utilities. So they span a wide range. And since Warren Buffett took over in 1965, he's been returning 19.9% compound annual growth rate, CAGR. That is 60 years of market-beating return. He turned $1 into $55,000 over that time period. Compare that with the S&P 500 at 10.4% returns. That turned $1 into around $390. Even if Berkshire Hathaway stock dropped 99%, Warren Buffett would still have a market-beating career. So what does it mean now that Warren Buffett is stepping down from Berkshire Hathaway as the chief stock picker? At the same time, the nonsense news is focusing on the massive cash pile. The company has $348 billion of cash sitting on the sidelines, not being invested in companies. So does that mean Warren Buffett thinks a crash is right around the corner? Or are there no good investment opportunities that he sees on the horizon? With him stepping down, is he waiting for his successor to take over? So let's see what the long-term trends tell us about Berkshire Hathaway as a stock to invest in. So here we are at ValueGlance.com, and we're looking at a plot of the ROIC, shown in blue, compared to the weighted average cost of capital, shown in orange, over the last 10 years. Remember, a high, steady, and increasing ROIC well above the cost of WACC means the company is creating long-term value. Now we see over the past few years, Berkshire has maintained a steady ROIC above the cost of capital, 2023, 2024. And if we go ahead and look at the values, we see that's about 11%. It's in that 10 to 15% region. Now we can go ahead and add in the invested capital. So that's shown here in purple. And this is telling us the amount of equity and debt controlled by the company. And we see at around 780 or so billion dollars of invested capital, we're getting a 11% ROIC. Now remember, the company has $348 billion of cash on the sidelines. And so if we were to factor that out and compute the ROIC, it would actually jump to almost 20%. And so this tells us that Berkshire is a quality company, steady company, as has been maintained by the investing philosophy of Warren Buffett and Charlie Munger over the years. So that hasn't changed. If we look at the growth of invested capital over the past 10 years, it's about 9.5% annualized. And if we were to look at revenue, it's about 6.6%. So that's not exactly up and to the right explosive growth, but it is solid and steady. This shouldn't come as a total surprise. The company is $1 trillion in market cap. That means there's a problem of scale. When you get that big, there's just fewer opportunities to invest in that can move the needle and trigger massive explosive upside growth. Now let's consider the value. So here's a plot of the hype factor in green compared to the equilibrium hype in pink. So the hype factor measures a ratio. It's the ratio between the invested capital market price and the invested capital book price. So we can think of it as a multiplier that the market is willing to pay to acquire the invested capital. We see that the hype factor is at its highest level, hit 1.6, and is the highest not only in the past 10 years, in fact, that's the highest it's been since 2008. We can go ahead and zoom out here. We see the last time it was that high was 2008. If we want, we can go ahead and press jump to today. And so this will actually give us the current values adjusted to today's price. We see it drop down a little bit. So that's around 1.5 of the current value of the hype factor. So what does this mean? So on an absolute scale, we can compare the hype and the ROIC to form the value creation yield, the ROIC divided by the hype factor. So for an 11% ROIC divided by a 1.5 hype factor, that's a 7.3% value creation yield. So again, the company is not in absurd valuation, skyrocket AI bubble territory. It's a reasonable valuation based on that number, comparing the ROIC to the hype. But at the same time, we see that the historical hype level has been peaking, at least over the past over a decade. And so that means the market is willing to pay a premium compared to how it has historically valued Berkshire Hathaway. But don't just take it from me. We can just look at Warren Buffett's own decisions when it comes to Berkshire Hathaway's stock. So going back to valueglance.com, we see the shares outstanding plotted in brown. And over time, it has been decreasing. And we see it flattened out and stopped dropping in 2024. So this means the company was buying back shares. The company would use its profits and go out into the marketplace, go to shareholders of Berkshire Hathaway, and buy them back. As a consequence, the people who held on to their shares end up with a larger slice of the equity pie. And so share buybacks are another way of returning value to shareholders in contrast to a dividend. We see the company bought back shares from investors, which reduced shares outstanding when the hype factor was bottoming out. And then since then, the hype factor has been increasing and the shares outstanding come down until 2024, when the company stopped repurchasing shares. So this suggests that Berkshire Hathaway feels the better long-term investment decision is to have a giant pile of cash rather than going out into the market and buying their shares from Berkshire Hathaway shareholders at the current prices. So even Warren Buffett, the GOAT of stock picking, who buys wonderful businesses at fair prices, doesn't see the current price of Berkshire Hathaway at a sufficient discount to warrant buying more shares back from investors and shareholders compared to holding a giant pile of cash. So taking all of this together, Berkshire Hathaway in its current form doesn't fit the mold of a high-quality compounder business, a business that is aggressively reinvesting profits for growth. Instead, the company is still a high-quality business and knows how to put capital to work, but at the moment is holding on to this massive cash pile that is sitting there waiting for the next opportunity. Now, Berkshire has a long history of demonstrating the company can wait patiently for what Warren Buffett calls the fat pitch, the right opportunity to come along. But the reality is that at this scale, there are just fewer opportunities for high growth investments. Remember, no one can predict the future, especially in the near term. But by studying these long-term trends, we can avoid the latest hype and nonsense in the news. So invest for the long term and keep compounding knowledge.